You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comprnell. The vast majority of those who work for state and local governments participate in a public pension system, tying the fiscal trajectory of states and municipalities closely to their management of their employees' pension systems. The pandemic increased volatility for these retirement systems in terms of both contributions and outlays, spurred by unpredictable population inflows and outflows, rapid Fed tightening, large fluctuations in asset prices, and decades-high inflation. On today's episode, we talk with JP Aubry, Associate Director of State and Local Research with the Center for Retirement Research at Boston College, about the fiscal health of public pension systems, how they've adapted to changes through the pandemic economy, and how they'll manage some big challenges in the years ahead. Stay tuned. Coming up soon, our interview with JP Aubry, but first, a quick market update. Financial markets have been laser-focused on U.S. political developments after an incredibly dramatic past 2 weeks. Republican presidential candidate Donald Trump survived an assassination attempt only days before choosing Ohio Senator J.D. Vance as his vice president and speaking at the Republican convention. Last weekend, President Biden announced he would not seek re-election. Vice President Kamala Harris received his endorsement and appears to have enough delegates already to lock up the Democratic nomination at the party's convention in 3 weeks. Financial markets are still not sure what to make of Harris's candidacy just yet, though we've seen a few instances of steepening in the Treasury market the last few weeks whenever Trump's perceived probability of winning the White House has increased. The intuition is that his policies would widen the fiscal deficit and increase long-term inflation expectations, pushing up long-term yields but not impacting near-term Fed policy expectations. The macro landscape during the last 2 weeks otherwise reinforced expectations for a rate cut at the September FOMC meeting. Fed officials gave no hints of considering a policy move on July 31st, before the pre-meeting silent period began a week ago. Also, some red-hot retail sales data dampened any fears of an economic downturn that may have encouraged the Fed to ease sooner. Today's June PCE showed tame inflation to end the quarter after yesterday's advance release of Q2 GDP reported 2.8% growth, with strong increases in personal spending and business investment. We don't think any of this changes the likelihood that the Fed primes markets for a September cut at its meeting next week, but it does give the hawkish FOMC members an argument for further patience before easing policy. Treasury yields across the curve remained essentially unchanged from where they were 2 weeks ago. Despite all of the recent political developments, the macroeconomic landscape is still the primary driving force of bond market pricing. Yields on 10s have oscillated within narrow ranges, centered on 4.2%, reaching a post-CPI high of 4.29% on Wednesday this week. 2s briefly pushed through 4.54% before a solid auction propelled yields down closer to 4.4% towards the end of the week. That's all for the market update this time. Now our interview with JP Aubry. Our guest today is JP Aubry, Associate Director of State and Local Research with the Center for Retirement Research at Boston College. JP, thanks for coming on the podcast.
Thanks for having me, Will.
Our topic today is state and local pensions, how they fit into the national retirement system, as well as their impact on state and local budgets. Now, I think defined pension benefits are not as common in the private sector as they used to be. There's been this shift towards relying more on 401ks, IRAs, or just Social Security for retirement income. But in the public sector, pensions are still somewhat prevalent, and they are a big part of the budgets for a lot of states and municipalities. So, JP, how many people in the U.S. right now are covered by or paying into public pensions right now in both absolute numbers and as a share of the workforce?
The way we like to think about it is usually the easiest way is the share of the workforce. So 10 to 15% of active workers in the U.S. right now are covered by a state and local pension. I mean, it's essentially almost every state and local government worker is covered by a defined benefit plan. And so, you'd said it's still somewhat prevalent. I would say it's still extremely prevalent in the public sector when you're talking about the type of benefit provided or the primary benefit. Defined contributions are often available and provided, but almost every state and local worker has access to a defined benefit plan, and they make up around 10 to 15% of the workforce.
And so these public pension plans, are they meant to supplement Social Security, or are they in lieu of the remaining 85% of us pay into for Social Security?
Like the majority of private sector workers, the majority of state and local workers also participate in Social Security. So the state and local DB pension is meant to supplement or be on top of of Social Security benefits. Only about a quarter of state and local workers don't participate in Social Security. In my home state, Massachusetts, that's one of them. So if you're a teacher or police officer or just work at the DMV as a Massachusetts government employee, you don't participate in Social Security. You're not paying in while you're working.
Now, when it comes to the budget trajectories of these systems, when you think about the changes in pension funding or outlays year to year, what are the key drivers that are changing those trajectories? Is it change in political power, population growth, economic growth? Are a lot of those trends baked in over time, and year to year you're not seeing many changes?
I think the latter is more the narrative for public pensions. They're long-lived entities, just like state and local governments. They work on kind of a population level in terms of their dynamics. That being said, they're facing the same challenges that the nation and many Western nations are facing writ large, that we have a large population of retirees, of older workers that are retiring, and a smaller generation of active workers following them. And so what that means is you have a big draw on the system, some money that's been saved up in the pension fund for years as these workers were employed and saving money into the pension fund and contributing. They're now drawing down those funds. And it just so happened that the timing of the drawdown phase of pension funds coincided with a pretty rocky 20 years in terms of the markets, led to pension funds being challenged in terms of their funding and needing to put in more money than they have historically. That being said, pension funds made significant changes kind of a decade into the turn of the century. So basically right after the global financial crisis, or in the wake of that, they cut benefits for new hires, and that bent the cost curve or flattened the cost curve going forward. They also hired fewer employees, so they had smaller growth in liabilities from active employees earning future benefits. And they also started putting in more money on the government side in terms of funding the system. So bending the curve on the outlay side, putting more money on the contribution side helped kind of right the ship for pension funds in spite of the kind of demographic challenge that they're facing. Actually, in the past 3 years, we've actually seen the funded ratio for pension funds in aggregate increase for the first time for 3 years in a row.
I want to talk about the pandemic disruptions to some of those trends that you just talked about in just a bit. But just as a general question, would you say that most public pensions are in a healthy state right now? Are they approaching some sort of inflection point like we tend to hear about stories with the National Social Security system?
I think for pension funds, it's a very different dynamic. The notion of exhausting their assets or hitting a crisis point is really pretty far-fetched for most pension funds. There are a few out there that really have near-term cash flow issues that can only be rectified by either paying less out soon or putting more in soon. But for the majority of pension funds, they could actually continue infinitely in their current state, even if they remain underfunded. Money going in and money going out, plus returns, on a cash flow basis, they're extremely sustainable. In our line of work, when we look at pension funds, we are thinking about incremental changes to improve the trajectory, but not a concern about an imminent crisis.
That's all very encouraging. I have to say, where I grew up, it seemed like the public pension system was a big source of budgetary concern. I want to talk about the political incentives. I know it sounds pretty cynical, but it is also just the case that in representative democracies, elected officials are usually incentivized to think more in the short term, which is getting reelected. And public pensions seem to me to be an instance where this misalignment could be particularly dire. So an incumbent will increase benefits to boost approval now, but of course at the cost of longer-term fiscal health. When you talked about, just after the financial crisis, lowering that cost curve and increasing revenues, How did municipalities and states come to the realization that they needed to do this when the political incentives aren't always there?
Yeah, you raise a good point. When I think about pensions and budgets, I often think of pensions as just a symptom rather than a cause. So oftentimes people will point to the troubled states like New Jersey or Illinois. But in those states, if you look at any other part of their budget and finances, you will see similar dysfunction. That these states have challenges generally in terms of governance that play out in the pension fund, maybe more so than other areas, but it's just a symptom of a kind of larger governance issue in certain states. And it's not clear to me that defined benefit pensions are suitable for all governments if they can't really manage them. It takes real grown-ups to be in the room to run a pension fund because of all the issues you just mentioned. But when the financial crisis hit, it was pretty severe. There was a big decline in revenues. There had been a run-up in benefit increases in the 80s and 90s that kind of increased benefits beyond what the initial kind of intent of the pension benefit levels were when the plans were implemented. And so in a way, what you saw after the global financial crisis was a return to what they were before the 80s and 90s. And, if you look at pension benefits or the overall retirement security of state and local workers, I think when reforms were made in many states, the case was made that if you look at retirement security overall, that state and local workers were still being taken care of by their employers in the sense that when you add Social Security, when you add the pension, and you add whatever small amount of savings, that most state and local workers were getting, 80% of their pre-retirement income in defined benefit form. And that's a pretty secure retirement for most.
Let's talk then about the last 4 years. This is, of course, a big theme on this podcast and anything involving the economy, current events, whatever, which is how COVID has disrupted the pre-pandemic trends. So I'm sure that public pensions were not immune to these disruptions. How have they survived the shocks that come with things like big domestic migration, federal government windfalls, or fluctuating investment returns because of the volatility in financial markets? All of these things have been very quick changes, often unpredictable, often susceptible to the political winds of the day, week, or month. Have public pensions been able to survive so far 4 years into the pandemic, or are some of them showing some cracks that are signs of distress?
Yeah, that's a good question. I'll start with COVID, and we actually looked at pension funds in the wake of COVID, especially in the beginning when the markets really tumbled dramatically in March. If you recall, 4 years does seem like a lifetime ago. They rebounded pretty quickly, and then on top of that, state and local governments were given support through ARPA funds, so they were able to maintain their workforce. They were able to fund their pensions, and essentially pension funds came out just fine over the course of the more severe kind of periods of COVID, because markets remained buoyant and they were given assistance to maintain their revenues and maintain their employment, which was necessary during COVID because of the core services that state and local governments provide.
Those initial disruptions, I think, they have, fingers crossed, passed at this point, but there are two scars, I would say, from those early pandemic shutdowns that we're still dealing with, which is higher interest rates and some elevated inflation. And I know financial institutions are still struggling to adjust to that, and it was only 15 months ago that we had some regional bank failures. So how are public pensions adjusting to those changes in terms of having to increase benefits for the higher cost of living, or maybe even shift investments because of this higher interest rate regime?
Yeah, it's a very good question. The financial markets have been kind of buffeted over the past 3 or 4 years for the reasons you just mentioned. Inflation, higher interest rates, market volatility, and pension funds have weathered those challenges relatively well. On the inflation side, in terms of the outlays for pension funds, oftentimes when researchers or the lay public think about state and local pensions, they think about inflation protection and COLA benefits for retirees. In point of fact, most pension funds have very limited COLAs, such that they only partially adjust for inflation, and also often have caps that limit the total inflation increase to 2.5 or 3%. So when we were experiencing kind of 9% inflation, that was not translating through to increases to benefits for retirees. A portion of it was, around 2% or so, but the rest of it was there were limits on the COLA increases, so those were not being passed through to retirees. So in that sense, pension plans were well protected against really high inflation. On the flip side, state and local government retirees were not, and especially if they weren't covered by Social Security, which does provide full inflation protection. On the interest rate side, pension funds actually have been reducing their holdings of fixed income assets for quite some time. They used to hold around 30% in 2001, and now it's down to about 25 or maybe even 20% in aggregate. So their exposure to interest rate risk is much lower than it used to be. And the other asset classes that they hold have done really well. And so that overall returns have met expectations for their overall portfolio, even though the fixed income component has really taken a hit as interest rates have risen.
What has been the motivation behind shifting away from fixed income within these portfolios? Is it because interest rates were so low for so long? Did they feel like they needed to engage in more risk to kind of keep returns that are comparable with 401ks or things that have more weight on equities? What was the driving motivation behind that?
Yeah, so pension funds, they have a funding regime, or their funding structure is predicated on hitting an assumed return. So all the cost metrics that they sketch out, all the required contributions they ask for from governments, those are all based on an assumed investment return for their portfolio, which used to be around 8%, but today is around closer to 7%, but still a pretty high benchmark to meet when bond rates were giving you 2%. And so most of the shift away from fixed income was, yes, a reach for yield, effectively, because they had a high bogey that they had to hit. And in point of fact, even though their assumed return has declined since 2001, their real return, which is kind of the return over safe assets, has actually increased. It used to be 4, but now it's 4.5. So they're actually expecting lower safe returns going forward, but higher returns relative to those safe assets on their risky portfolio, which aligns with them shifting more into risky assets, shifting into private equity, things that will give them a higher premium over the safe assets.
And so that shift into riskier assets, I mean, there was, of course, some feverish growth in risk assets towards the end of 2021 and into 2022. And then when the Fed started to hike rates, there was a down-to-earth reality moment. And so pensions have still been able to survive that correction, even though there's been a shift to riskier assets?
Yeah, they have. I mean, their portfolios so far, in terms of things like private equity in particular, are still achieving returns, at least on paper. The pension funds are reporting. But we've actually found, we just did a study looking at the shift away from traditional stocks and bonds into other more opaque and private assets to see how well that pension funds, that transition has compared to a basic 60-40 portfolio of index stocks and bonds. And we found that since 2001, there's been really no premium earned by pension funds relative to a 60-40 portfolio. And so, while they've been able to, yes, kind of maintain the return that they're seeking, they're going about it in a very complicated way and an opaque way, in a way that invites scrutiny, when it seems like a 60-40 portfolio would have gotten them the same outcome in a much more transparent fashion.
I know you said that most of these pension systems tend to have pretty good fiscal health, but I want to go through a scenario where, let's say, a municipality or state overpromised on benefits, they're seeing a lot of migration outflows, and things are looking dire. Are they able to declare bankruptcy if their pension systems become insolvent? And what would this look like? I just sort of imagine that, you have that cost curve, you have the contributions trajectory, and if time goes on and they're not really converging, it becomes very difficult to make them solvent again. So is bankruptcy something that they can do?
Right, and with each year, it gets harder, right, if you're on that path. In the United States, Chapter 9 allows municipalities to declare bankruptcy. States cannot. When the global financial crisis hit in 2009, there was a flurry of experts predicting the rash of bankruptcies, in particular related to pension funds, or as a result of poor pension fund management or unfunded liabilities. That never came to pass. We had one, Detroit, and it's not clear that Detroit's bankruptcy was because of its pension. It had lots of other serious financial issues. But your point is well taken that smaller government entities where out-migration is a real risk do face different challenges. And once you build up a legacy debt, a promise, this liability, there's really no way to adjust it. And that's part of one of the challenges of pension funds when you have population change. When you have a huge legacy liability or a legacy of promises that can't be sustained by the population going forward. How does a government manage that? There are other ways besides bankruptcy, seeking other kinds of fiscal assistance, generally from the state, to help smooth over the pathway. But bankruptcy is also one of those options, and we saw it in Detroit.
I guess that speaks to what you said earlier, that if a state or municipality's pension system is not looking very good from a fiscal health perspective, it's probably overlapping with some budgetary issues outside of the pension system, and it's not the pension system per se that is the primary driver. Now, I want to end with just looking towards the future, considering all that seems to be in the rearview mirror from the last 4 years of the pandemic. We've still got challenges related to demographics. There's always political uncertainty. There is a question of population migration. Will some of the domestic migration boomerang back to where it was before the pandemic? Is international migration going to continue? Considering all of those challenges, what do people in the sphere of public pensions see as the most important things to look at going forward? And what do you think are the most promising approaches to reform to make sure that these systems stay intact and healthy?
I think one, with all the potential headwinds that you just mentioned, I think one of the important characteristics of pension funds going forward is flexibility. And so I think what we're seeing more are pension funds instituting policies, benefits, and benefits that are contingent on certain outcomes. So they have an expectation for a certain long-term return, they have an expectation for certain other financial metrics, and to the extent that those expectations are met, the promised benefit will be provided. But there's also wiggle room set up within the system such that if any of these major financial metrics are not met, that there's a series of adjustments that will be made almost automatically to the pension fund by either reducing benefits, not offering a cost of living increase, automatically increasing employee contributions, automatically increasing employer contributions, etc., such that the system can adjust in real time with changing financial dynamics within some agreed upon range. And I think that was what was lacking from the public pensions system in aggregate prior to the global financial crisis. And make no mistake, the risk sharing and this kind of flexibility did occur, it just happened ex post after the fact, and it happened in kind of an ad hoc way and caught people by surprise because they were not intending to have their benefits changed if something didn't turn out exactly as expected. So benefit cuts were a surprise and there was a political cost to pay. But I think going forward, pension funds are thinking more clearly about the fact that bumps in the road do come. How can we set up our system and communicate it to our members and our state and local workers, the things that would happen in the event that X kind of scenario occurs or Y kind of scenario occurs, with the hope these bumps are just that, bumps, and when things get back to normal, we'll be able to reinstitute the long-term expectation that we have for what we'll provide.
JP Aubry, thanks for coming on the podcast.
It was my pleasure. Anytime.
That was JP Aubry, Associate Director of State and Local Research with the Center for Retirement Research at Boston College. JP makes a really interesting point about how public pensions were able to lower the cost curve and shore up their respective fiscal trajectories during the last 15 years. I was also surprised to hear that most public pension systems are a correlate to poorly managed state budgets rather than being a primary cause of overall budget shortfalls. The FOMC meets next week and is expected to leave the Fed funds rate unchanged at its Wednesday afternoon policy announcement. There will be no new summary of economic projections, but the policy statement and Chair Powell's press conference will determine markets' expectations for the likelihood of a September rate cut and the rest of the year. Treasury's next quarterly refunding estimate and announcement will also be next week. We expect coupon auction sizes for the next 3 months to be unchanged from their sizes last announced in May. The share of bills as a percentage of total marketable outstanding debt is slightly higher than the recommended 15 to 20% right now. If coupon auction sizes are to increase, Treasury will communicate it well ahead of time so that the higher issuance would be smoothly digested by financial markets. On the data front, the July jolts will come Tuesday before Wednesday's second quarter employment cost index and July ADP employment data. The ISM manufacturing on Thursday has the potential to move markets after the preliminary S&P PMIs this week surprised to the upside. The most important release, however, will be the July employment report next Friday. The consensus expectation is for job growth to remain steady at just under 200,000 and the unemployment rate to stay at 4.1%. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.